Over the past couple of years, we've actually seen a significant increase in real estate investors and real estate investing, those looking to get into this industry. Because the reality is that, interest rates are, homeowners are conscious to interest rates, right? But I'd say real estate investors tend to look at interest rates, as kind of like you mentioned earlier, Brett, as kind of just a cell on an Excel spreadsheet, right? I got to plug in that interest rate to determine whether or not my property is going to cash flow or how much it's going to cash flow. So we just plug in that interest rate to find out. And so when this void was created, it afforded people to want to get into real estate investing to be able to do it, and those who were already in it to grow their portfolio expansively more.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. We are talking about money today. And what's that mean for the real estate investors listening? Well, we're going to talk specifically about leveraged money and getting outside of the box, talking about some non-QM products like a DSCR, debt service coverage ratio loan, these fix and flip loans. What a great opportunity to dive in from a borrower's perspective and ask what's going on in the market. How do I even know what the interest rates are going to be? What kind of rates should I be looking at? Should I buy now? Should I wait? Well, I tell you what, today's conversation is diving into just all of that with a couple of people from Sincere Mortgage Group. Today, we're talking with Scottie Talaski. He's a father, a husband, and man, just a real estate mortgage expert, breaking into the non-QM world to help us real estate investors. Also invited his partner, Mike Easton, as well too. So, man, let's dive right into this and unpack some of this stuff and on what this leverage world means to us real estate investors. Everybody, please welcome Scottie and Mike to the show. Right, if I could, man, here we go in this conversation. If I could do the take two thing, here we are, take two. For the listeners, it's take one. Everybody, man, I'm excited to jump into this conversation with Scottie and Mike from Sincere Mortgage. And what a great time to be talking about mortgages at this time of the year where everybody's at. Man, there's so much to jump into. Mike, how you doing today, man?
Hey, it's a great day. Started off early morning, got a nice workout in. I'm working out in this infrared sauna gym now, which is really cool. It's high intensity, short bursts, and it's just a great day.
Great day. It's a great day to have a great day. I feel like I've heard that already today. Hey, what I was saying earlier too, before we started recording was in gym and real estate and investing is just like, I watch people get excited in the beginning of the year with their, you write down these goals for the year and then it kind of falls off. But I even see that during the week. So Monday versus Wednesday versus Friday and how that falls off. So I say to you, my friend, be consistent, stick with it. You got it, Mike.
Thank you.
You're good. And it feels good too. Like the rest of the day, sometimes it's a struggle to get up and get there. But man, once you're there and the rest of the day just feels so much better. How about you, Scottie? It's a good day to be a great day, right?
Amen, brother. Amen.
Man, we are rolling hard now. The time clock is running. So let's jump right into this. I'm not a physician. Scottie, you're not a physician. Mike, you're not a physician. But here we are on the Real Estate Mogul MD. So you guys are, man, you're money doctors, right? You're money physicians. And we don't mean to offend anybody out there that's listening, that's worked so hard and dedicated their life for that, the MD on the outside of their name. But tell us a little bit about your professional background, Scottie.
Yeah, definitely. So, and it's funny to bring that up, Brett. My neighbor is a NICU nurse,
Yep.
And was grateful enough to be able to do the mortgage, that they used to purchase their home, and have come to know them. They're really great people. So I have a great appreciation for those who work in the medical field and our doctors that do everything they can to take care of us. And my personal story, began, close to 9 years ago now in 2016 when I got started in, real estate and in mortgage. And started at a small retail firm that quickly grew into a large one, and learned how to do what I do. And it was through serving the clients that I was able to serve there that I realized there was a client base that I wasn't able to serve at the same level. At the retail firm that I was at, we were really good at doing conventional VA, FHA, traditional cookie cutter, loans for homeowners, right?
Inside the box.
Yeah, right. Inside the box,
Yeah.
But for our real estate investors out there that, want to grow their portfolio and, leverage the equity that they have in their homes to grow their financial wealth, there was just, products that I didn't have access to and couldn't offer to my customers. And so, fast forward from there about 5 years, and I connect with Mike, and he felt my pain as well, coming from the same company I did. He just made the switch over to the broker world sooner. I joined him about a year ago, and we connected with the same vision to want to serve real estate investors. So, we have pivoted to focusing our efforts to serve primarily real estate investors, those who, like I just mentioned, are looking to grow their real estate portfolio, and offer them a diverse product of loans that will enable them to do so. And so we've gone all in, to do that, and have entertained a lot of success over this past year, growing our business to serve those as well. And I think that this is a good opportunity for us to maybe segue into how Mike and I have been creative in being able to do that.
Yeah, Mike, tell us a little bit about this kind of like inside the box thing, moving from that other brokerage to creating this one. And we're talking about Sincere Mortgage, right? SincereMortgageGroup.com is where the listeners can find and learn a little bit more about you in 11 states, which is also kind of unique. And it's not, a typical scenario for some local banks and credit unions where, you've got a pretty good range where you could do this. But when we talk about this product, offering it for real estate investors, when I first started, it's like I didn't know about certain products. So I feel like we're talking outside of the box. We're talking about non-conforming mortgages, right? So they don't fit in the Fannie Mae and Freddie Mac box. What does that mean for the listeners?
Yeah. So, talking about non-QM loans, if you think about it, your traditional bank, your traditional mortgage company, they do about 4 or 5 different loan products. And most of the time, they might underwrite those loans right in-house. So like, think about if you're going to Geico to get your auto insurance, they can only write you a Geico insurance policy, right? Even though there's hundreds or thousands of different options out there. And so what we did is, we were having some challenges at the other company we used to work for. And ultimately it was just that we couldn't help enough people with what they actually needed, because people would call me all the time and say, hey, can I do this? Can I do that? And I said, no, we've only got 4 or 5 products. So I said, after that happening, enough times, I was like, okay, well, it's really time to make a switch. We need to upgrade our product offering. And so we, transitioned over to the brokerage side of things, where we can offer these non-QM loans, DSCR loans, fix and flip loans, closing an LLC, commercial financing. Pretty much if there's a mortgage product out there for what you're trying to do, there's a good chance that we have something where we can, get that done for you.
So non-QM, non-qualified mortgage, just meaning that it's not going to be sold to a certain person or backed by a certain thing, or what does that non-QM mean?
Yeah, so like the traditional conventional loans are backed by Fannie and Freddie, right?
Okay.
So there's certain parameters that they underwrite to, and that's just pretty much across the board. When you have the non-QM loans, it's a totally separate, different pool of investors on the secondary market. And so, there's, hundreds of different lenders that offer, let's just say, DSCR loans. Not all of them offer DSCR loans in the same capacity. So like some of them might have a restriction on one thing, whereas, another lender might not have that same restriction. And so being able to place those loans with the correct lender and the correct loan product really allows for, a lot more magic to really happen. Whereas, if we didn't have those options, sometimes the answer is just, well, we can't do the loan for you. I'm sorry.
Yeah.
And it's not a good way to, end a, conversation with someone, where it's like, I'm sorry, you're just out of luck. It's like, I like to end it and be like, hey, I'm ready to go to work for you.
Yeah.
I'm a specialist and we're going to get it done.
So setting this up, and these loans actually qualify. Why they don't qualify is we're looking at different terms to basically mitigate the risk for the lender. And one of these big buyers, I'm assuming, on this secondary market, air quotes, is BlackRock, a big, massive company that buys these type of loans. As a borrower, then once that loan is sold, it's very typical that probably I'm going to a different servicer and those kind of things. But if we're on these non-QMs, how does the rate work? I mean, does that follow the same as the Fannie Mae, Freddie Mac, where maybe it's maybe somehow follows the Fed rate? Or tell us a little bit about that, Mike.
So as far as like the rate trends and things like that, a lot of times they do, as the Fannie Mae rates go up and down, these non-QM rates a lot of times will sort of move in tandem with those. But it's, again, it's different from investor to investor. Like, so some non-QM lenders, they'll only update their rate sheet like once a month. Some will update theirs, once a week, and then some will update it daily. If we're talking Fannie Mae, FHA rates and things like that, those are changing, by the hour sometimes. So in some cases, the non-QM rates can actually be a lot more stable than like the Fannie Mae or the conforming rates.
And I've gotten the feel too, it's like sometimes on the DSCR side of things, we're actually looking at or anticipating the Fed either dropping or holding. So sometimes it stabilizes even more based off of projections. So in this idea, and I was talking here a little bit before, and I got a little smile out of Scottie when I said, hey, I've heard somebody tell me I marry the house and date the rate. So what kind of weddings are we having now in today's market versus, what kind of dating is going on with these rates? What in the world's going on, Scottie?
Yeah, well, so I think that a lot of homeowners or home buyers that were told to marry the property or marry the house and date the rate, they've been dating this rate a little bit longer than they've wanted to. Yeah. They're wondering how much longer they're going to be stuck in this bad relationship, and maybe that relationship even changed a couple times over the past year or two with 2-1 buy downs, 3-1 buy downs, where customers were offered a subsidized interest rate up front with the expectation that we'll see interest rates decline sometime over the next year or two, and they'll be able to refinance into a 30-year fixed rate mortgage interest rate that's lower than what the market rate was at the time that they locked in that bought down interest rate. But this really lends the line to a much bigger discussion, and that is about the state of the market, the state of the economy, and how that's really impacted, home purchasing and refinances over the past couple of years, and then, even what they could look like, in 2025. So anyone who's been in the mortgage industry, over the past couple of years would tell you that, it's been tough, right? Interest rates are elevated. I can remember, a while back, a leader at my previous company had told me that, hey, Scottie, do what you can while you can. You never know. You could wake up tomorrow and interest rates will be at 6 or 7%. And I laughed at him. I'm like, hey, interest is 3%, 3.5% right now. And, one day I woke up and I felt like I was looking at interest rates being 6 or 7% and even at, one point higher than that. So that's really been the reality of the mortgage industry the past couple of years. Now, it's had an interesting effect on the housing market. I would say that we've seen fewer, and I'll make that distinction now between a homeowner and an investor, right? Brett and I, we just mentioned that a moment ago before we hopped on. That a homeowner is someone who is living in their house. They bought a house they're going to live in and have a family in. Whereas a real estate investor is somebody who looks at acquiring properties as a way to generate cash flow and grow a real estate portfolio, and ultimately have a revenue producing asset that they're not working to have to make, right? So what we've seen in this elevated rate environment is perhaps a slight decrease in homeowners or those looking to become homeowners, but The converse to that is it's also provided an opportunity for real estate investors because, um, you know, home purchasing didn't stop when interest rates got to 6 or 7%. They just flat out didn't. Now, homeowners might have slowed down acquiring, or not acquiring, but buying houses to grow their families in. But what it afforded was real estate investors to step in and fill that void. And so I would say that Mike would agree that over the past couple of years, we've actually seen a significant increase in real estate investors and real estate investing, those looking to get into this industry. Because the reality is that, interest rates are, homeowners are conscious to interest rates, right? But I'd say real estate investors tend to look at interest rates, as kind of like you mentioned earlier, Brett, as kind of just a sell on an Excel spreadsheet, right? I got to plug in that interest rate to determine whether or not my property is going to cash flow or how much it's going to cash flow. So we just plug in that interest rate to find out. And so when this void was created, it afforded people to want to get into real estate investing to be able to do it, and those who were already in it to grow their portfolio expansively more. And I would say that we're going to continue to kind of see that trend, at least going through this year, perhaps into next. Now, in case you didn't know, we have an election taking place next month. For those who've been living underneath a rock for the past 6 months, and the expectation is that for a lot of homeowners, that this will somehow create a massive ripple effect in the real estate industry, and in effect influence mortgage interest rates, whether those are going to continue to stay where they're at right now or they're going to come down. But the truth of the matter is that I don't know, and I don't think that anything that happens next month is really going to change that, at least in the immediate or short term. So looking ahead into 2025, I say that interest rates are going to remain largely unchanged. Real estate transactions are going to continue to happen. Real estate investing is going to continue to happen. It may even be at a much greater pace, because if we do see a little bit of a downtick in interest rates, I can only expect that those who want to invest are going to see the opportunity as being even bigger than it was before. And for those who were already in at elevated interest rates, 6, 7, 8%, when they acquired properties over the past couple of years, are going to be able to, to refinance at a lower interest rate and even bumped up the cash flow on their properties even more. So I look ahead here and think, like, we're in one of the greatest times economically as a nation and as an industry. I mean, the ability to be able to take advantage of these opportunities are just gonna be the difference for a lot of investors out there. To grow and expand their portfolios and generate more wealth. It's incredible.
So growing and expanding a portfolio is the key to that in your perspective of maybe the economy, based off of, hey, I've been able to put the time in, because I know there's a lot of people who may not have that ability, whether it's the knowledge, the experience, the drive, the passion to put out that kind of return. But for me, having that opportunity now and being able to turn where these rates come up and come down just into another day off that cell in my spreadsheet that you were talking about. And if I'm projecting to hit a 90-day close on a loan, I'm trying to do my best to project that interest rate. We talked a little bit about how that rate works, Mike, off the Fed or off a dozen. And then we talked too on, I know that it's going to be affected by the LTV that I'm asking for. I'm going to have a higher interest rate if I'm asking for a higher loan, right? There's more risk in that for the lender. But ultimately, it comes down to the acquisition equation, and that's how you're going to find deals. And Scottie, I did the same thing. I watched this cell in my spreadsheet go from 4 to 8. But guess what? I still closed 22 deals that year. So I watched the rate double and I still closed 22 deals. Now, how happy am I when I see this economy as an opportunity? Because now as we start to drop, guess what? I'm ready. I'm ready for that 1 point drop. And that's going to make me happy. Making sure I'm expanding my associations and building my relationships with the right people, staying outside of that box. I see so many people get trapped inside of that box saying, I have to put this in my personal name. I have to do this. I have to do this. Or even that, I'm just gonna wait till next year. The best time to plant a tree is today and 20 years ago, right? So imagine if that person had already just jumped into real estate, given they have the right resources, the right acquisition equation last year or 2 years ago. I mean, it's remarkable. Now we are here, and you mentioned, Scottie, this, we're recording this at the end of October here in 2024, and this is an election year. We're going to be electing a president. And yes, even though that president does not directly affect or have anything to do with that Fed rising or sitting or dropping, the policies can. And one of the things that I see, and one of the candidates would be offering a $25,000 down payment. So that kind of thing, a forgivable down payment or a loan or whatever it may be, that kind of thing would affect the home buyer market, the homeowner market, but could eventually even affect the real estate investor market, because that could drive up pricing. When people have money that's not necessarily theirs, they're going to be apt to spend it and prices are going to go up. So then maybe even foreclosures increase. And then there's another, you're talking about the way that the economy presents opportunities for investors. You got it. It's always out there. Just be willing to pivot just a little bit, know your systems, be confident in the process, trust the process. Mike, we do a lot of BRRRR in my personal portfolio, my company, Physician Wealth Systems, and I've done this for a really long time. The BRRRR strategy is buy, renovate, rent, refinance, and then repeat. And that's how we're able to basically leverage in order to stretch our money, give our money velocity. I've heard it said before. We're talking about velocity and supercharging something before, and I was joking of like the Hemi, make it go fast. Give me that BRRRR. What is this supercharged BRRRR that you mentioned before?
Yeah, so it's the whole BRRRR strategy just sped up and paired with a couple of different unique loan products that are a little bit more BRRRR friendly than your more traditional loan products. So like, let's say, if you're using a Fannie Mae or regular conventional loan and you're trying to implement the BRRRR strategy with that, sort of more of the traditional way, well, you can go ahead and renovate that property. You can buy it, renovate it, rent it out and everything, but you're not going to be able to refinance that property on the new appraised value until 12 months has gone by. So, a lot of people know it used to be 6 months before you could do that, and they just changed that to 12 months. And so that's not very supercharged, right? Who wants to wait around for a year after you did all this work to the property, increase the value, maybe you doubled it? You want to get that money back and repeat that process and continue it. And so when we start using these non-QM loans, a lot of them have the same restriction, but it's 6 months for the new seasoning period when you can go ahead and cash out, refinance that product. And so the trick is to use certain lenders that we have in our arsenal of lenders that we can write loans through. We want to use the lenders that don't have a seasoning requirement for how long you have to hold that property. So maybe it only takes you 3 weeks. Maybe you've got a good formula down. Buy and renovate that property. You want to go ahead and refinance that at the new current actual market appraised value. And so when we use the right lenders to do that, then you can do that DSCR loan, sometimes in as little as a couple of weeks after closing, once those repairs are done. So that's, one way to supercharge it. And the other way too is actually on the acquisition of the property as well. And so for experienced investors, we can actually do up to 100% financing for the purchase price plus the repairs on a given property. And so when you pair that all together, you can actually refinance it at the same lender that we did the original fix and flip loan through, and really kind of streamline the paperwork and allow the investors to really focus on what they do best, which is going out there and finding deals and of course listening to your podcasts, right?
I am. That's right. Supercharge it. Hey, so in this process, my experience, and I have not done everything. I don't know everything. even, to push record when that's my only job is to push record. Sometimes I miss that, right? No, just joking. On this process, I've done it where I've financed the whole thing, and then I've done the renovation. I've done where I've bought it cash, renovated in cash. I've done all of that stuff in the flip and then the flip to hold. Some of the challenges that I come up against is one is the appraisal world. Holy moly, the appraisal world. So finding this path to where if I have some sort of connection through that appraisal world, it does make my process a lot easier. But you are disconnected from the appraiser because of what happened in 07, 08. So that's one challenge I have. And then the whole process is if you guys lend the purchase and renovation, tell me a little bit about what that renovation escrow looks like and the process to do a draw.
Yeah, definitely. So, as far as being burned with appraisers and stuff like that, we've heard a lot of stories about this happening to people, especially when they're buying properties in cash. They're like, oh, I don't want to pay closing costs. I don't want to do this. I'm just going to pay it all in cash, and I'm going to trust my numbers that they're good. And then they go to try and sell it later, and the appraisal comes in 50 grand under, because they never had an appraisal done in the first place. One of the ways that we, really not us, it's really the lender's program that helps to mitigate that whole thing, is they're going to do an ARV appraisal on that property. So you're going to submit a scope of work and a rehab budget and a repair budget, and you're going to let the appraiser know, hey, I'm going to do kitchen, I'm going to do countertops, add a bathroom here, add 2 more bedrooms, and I'm going to do a 500 square foot addition on the back. Great. You're going to give that all to the appraiser, and he's going to calculate the after repair value on that appraisal. And what the lender is going to do is a lot of times they're going to lend up to 70% of the ARV appraisal figure that the appraiser determined right there. So that's purchase price plus repairs needs to be 70% or less than the ARV appraisal. Mm-hmm. So it kind of keeps everything in line. And then as far as the draws go, once your work is done, you just take a few pictures and then send it over to the lender and request that draw reimbursement to get sent back to you.
Okay, pictures. That's nice. I do like that. Typically, there's a small fee for administration to go through that process. But I do like that where I could submit pictures and probably have to present a draw schedule or something going into that. Does that sound reasonable?
Yeah. So that's going to be part of some of the initial paperwork that you fill out. Yeah. So there's a couple of different Excel sheets and forms, and the lenders do require, you have to fill it out all on their specific templates. So even though you have a perfect Excel sheet that works for you, they only work off of theirs. So
sounds like you've got that question in a time or two.
Yeah, we've had a little bit of pushback, but hey, if you want to get the $250,000 so you can make this equity, are you ready to play ball? Yeah, that's kind of what it comes down to.
Here's one for you, Scottie. I have an acquisition company, and I've got systems, integration, automations, years and years of experience to go out and source under market value properties. I've bought properties where I've got $40,000 to $60,000 in equity based off of what I'm buying it for and what it can appraise for. So if this property, I don't need any renovation on this property. I'm paying $100,000 for this property. I need no renovation. And I know I can prove to you and your appraiser that this thing, it can easily go for $150,000. How in the world do I get a DSCR to do this? It's a challenging question. And I've back and forth trying to figure out, but ultimately the way that I'm seeing this is I've got to acquire and I've got to hold it for 90 days at least.
Well, kind of like Mike had mentioned, with, we work with about 250 lenders through our brokerage, which I know sounds like a lot, like, oh my gosh, what would you do with that many different lenders? Well, it affords us the ability to really go through what we're looking for with a fine-tooth comb, and risk what we tolerance. Have, right? Yeah. And right, comes. And what we've learned is that we have come across lenders who are willing to make exceptions where the majority just do not. And it's not like there's 10 or 20 or 50 of them. There's 1, 2, maybe 3, right? But it's that difference. It's that little bit of a difference there that allows us to be able to do things that, I mean, just frankly, not, I mean, I don't want to say lenders, but even other brokers aren't able to do because they just don't, have that connection. They don't have that relationship already built, whereas we do. And so, kind of to follow up on that question, like, how do you get a DSCR on that? Well, I mean, I would say that it starts with a conversation with us, right? We are going to take the knowledge, the information that you have about the project that you're working on, and we're going to find a solution. I mean, we just will, because that's what we do, and we always do.
It's awesome. How about minimums? What is the minimum? Is there a minimum loan value? Is there a minimum appraised value? Tell me a little bit about that, Mike.
Yeah, so each lender is a little bit different. So, if we're talking about like we need to do like a $50,000 DSCR loan, I've got a small handful of lenders, maybe one or three different lenders that'll do something that's in the 50,000 range. A lot of them do have like $100,000 as the minimum loan amount. And it's not so much that they just don't want to do the loan because maybe, there's not enough money in it for the lender or this or that. It really comes down to like, different states have different points and fees tests that they have to kind of look at to basically make sure that, lenders aren't, price gouging people. And when you have the smaller loan amounts, because you're always going to have certain fees, like some lenders have a $2,000 underwriting fee, that's always what it is. Well, on a $100,000 loan, that's 2 points, right? So you're already starting to kind of throttle some of those points and fees tests. But yeah, across the board, if you want to kind of look for like, sort of an average number, in most cases, it's about 100,000, but there are instances when it can go down to like 50,000.
Interesting. Scottie, what's the biggest mistake that you've seen a borrower make in your experience so far?
Waiting.
Interesting.
100%. So, and that's the same for homeowners. That's the same for investors. I mean, just flat out, I've seen it in both cases. Prospective homeowners waiting for interest rates to come down before they go buy. So guess what happens? Interest rates come down. We pre-approve them. All right, we'll go find a house. Well, now what's happening? Well, there's 100 other people, 1,000 other people, 100,000 other people that were waiting just like you were. And now you're out there competing with them. And guess what that's causing? It's causing prices of homes to drive, to go up. And so now you were, going to be paying $200,000 for this house, and now you're paying $250,000, right? And maybe you're having to come in over asking price in order to get it, right? This was the symptom of, what we saw a few years ago when interest rates were, rock bottom. I mean, lowest they'd ever been, is it just drove home prices straight up. And a lot of home buyers who were sitting on the fence waiting for rates to come down, who finally moved, couldn't do anything. I mean, they were wanting to buy. They had the pre-approved letter in their hand, running out there trying to find something. They just couldn't do it, right? And so that's just the truth. And that's why, like, interest rates, we mentioned earlier, marry the house, date the rate. I mean, I laugh and I kind of make jokes about it, but to some degree, there is a little bit of truth there. For investors, though, again, it's no different, right? So, when interest rates were low a few years ago and home buyers were competing with each other, they were not only competing with each other, they were also competing with investors, right? Investors that were coming in and in some instances paying cash or putting large amounts of money down to where it was just like, oh, well, we just can't beat them out. Because, I was relying upon, this 3% or 5% down loan, but this investor's coming in and kicking in 20, and I'm a seller, looking at these offers and saying, well, I'm going to go with the guy that's going to put more money down, more skin in the game, right? So, with investors, it's similar, right? It's similar, and you don't wait, okay? And in this market that we're in right now, where homeowners are scaling back, throttling back their home purchases, like I said, it's creating this incredible environment, incredible opportunity for investors to come in with little to no competition at all and scoop up properties.
Don't wait to real estate. How about that? I think that's the slogan for the show. Don't wait to real estate.
I like it.
Mike, what's one thing that you could suggest to a real estate investor who is ready to bring you a deal?
So the first thing I would recommend is that, let's start having these conversations now, as soon as possible. Do your research, do your homework, figure out what it is that you really want to do. Start talking to some mortgage people, give us a call, book a time on our calendar so that we can start to really iron out the things that are really going to ultimately matter when you're looking to try to get to the closing table. There's no reason to wait to have this important conversation, 3 to 6 months from now because you think the rates or you think the presidential thing is going to do whatever which way. Like let's have that now. Let's build that relationship now so that we can set the table for really what you're trying to do.
Absolutely. And I'm always moving, man. I'm always real estating. I'm always doing something. Like I said before, we're doing at least 10 or 12 of these refinances right now, and it's all based off of projections. Everything's going to work. Trust the process, stick to it, and start. Don't wait. I think that's great advice. Don't wait to real estate. For those of you out there in the listening world, maybe seeing us on YouTube, sinceremortgage.com. These guys are in 11 different states, have these outside of the box. We call them non-QM loans, and the experience to put them together and to make it work for you, to be able to draw from their resources to help put this together. I think it's really cool. Fix and flip side. I'm seeing more probably along the lines of the DSCR, but the fix and flip is very cool as well too. Don't wait. Get out and check out Sincere Mortgage. Mike, Scottie, man, thank you for your time today. It's been an absolute blast. Thank you so much.
Thanks, Brett. This was awesome. Thanks for having us on.
Appreciate you, Brett.
Awesome. The listeners out there today, again, always thank you for your time and your attention. And given the attention to the money market is really important. Sometimes I get lost in thinking about it, and then the financial statement and all these documents, like Mike was saying, I've got to do this document, get past it, get over it, because I say this a lot too. Nobody's going to care more about your money than you do. These are the things that you need to give attention to and the relationships that you need to build to maximize your return. Really important. Check them out, sinceremortgagegroup.com. Hit them up, Mike and Scottie. Thanks again for sharing your time. Until next time, this is Real Estate Mogul MD.